The U. Debt ceiling is a limit set by Congress on how much the federal government can borrow to pay for its expenses. The current limit is $31.4 trillion, and it has been raised 78 times since 1960. If the debt ceiling is not raised or suspended by the time the government runs out of cash and borrowing capacity, which could happen as early as June 2023, the U. would face a default on its obligations, such as paying interest on its bonds, salaries to federal employees, social security benefits, and military pensions. A default would have serious consequences for the U. economy and the global financial system. It would erode the trust and confidence in the U. dollar as the world's reserve currency and the U. Treasury securities as the safest and most liquid assets. It would also trigger a spike in interest rates, a plunge in stock prices, a disruption in global trade, and a recession at home and abroad. The exchange rate of the U. dollar and other currencies, such as the New Zealand dollar, would be affected by the debt ceiling crisis in several ways. First, the uncertainty and risk aversion caused by the political deadlock would reduce the demand for U. assets and increase the demand for safe haven assets, such as gold, Swiss francs, and Japanese yen. This would weaken the U. dollar against these currencies. Second, the higher interest rates resulting from a default or a near default would make U. debt more attractive to investors, especially if other central banks keep their interest rates low or negative. This would strengthen the U. dollar against other currencies. Third, the economic slowdown and lower inflation caused by a default or a near default would reduce the growth prospects and purchasing power of the U. economy, which is a major trading partner for many countries. This would weaken the U. dollar against other currencies that have stronger economic fundamentals and higher inflation expectations. The New Zealand dollar, NZD, is one of the currencies that could be affected by the U. debt ceiling crisis. The NZD is often considered a commodity currency, as it tends to move in tandem with commodity prices, especially dairy products, which are New Zealand's main export. The NZD is also influenced by the interest rate differential between New Zealand and other countries, as well as by the risk appetite of global investors. Therefore, depending on how these factors interact, the NZD could appreciate or depreciate against the U. dollar in response to the debt ceiling crisis. One possible scenario is that the NZD appreciates against the U. dollar if the debt ceiling crisis leads to a default or a near default by the U. government. In this case, the NZD would benefit from its relatively strong economic performance, high interest rates, and stable political environment compared to the U. The NZD would also benefit from higher commodity prices, as a weaker U. dollar would make commodities cheaper for buyers in other currencies. Moreover, the NZD would benefit from increased demand from investors who seek to diversify their portfolios away from U. assets and towards more resilient and less correlated assets. Another possible scenario is that the NZD depreciates against the U. dollar if the debt ceiling crisis is resolved without a default or a near default by the U. government. In this case, the NZD would suffer from its relatively small and open economy, which is vulnerable to external shocks and trade disruptions caused by a global recession. The NZD would also suffer from lower commodity prices, as a stronger U. dollar would make commodities more expensive for buyers in other currencies. Furthermore, the NZD would suffer from reduced demand from investors who seek to return to U. assets and away from riskier and more volatile assets. In conclusion, the U. debt ceiling crisis could have significant implications for the exchange rate of the U. dollar and other currencies, such as the New Zealand dollar. The direction and magnitude of these effects would depend on how the crisis unfolds and how it affects various factors that influence currency movements, such as interest rates, economic growth, inflation expectations, commodity prices, and risk appetite.